CJ Stevens and Jerry Kalitzis work for Investia Financial Services, Inc. All opinions expressed by CJ and Jerry are solely their own and do not reflect the opinions of Investia Financial Services, Inc. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Investia Financial Services, Inc. may maintain positions in the investments discussed on this podcast.
Bantering Bosses, episode number 6. Happy New Year.
You too. I like the way you always smile when you enter this frame here. That's good.
Exactly, yeah.
That's good. What are we doing here?
Well, we have, it's been a while, and so we're getting to some a bit more heavier topics.
I can see the list.
An update on a few of the buzzwords from 2022 and an outlook for how they look for 2023. So it should be a fun one.
How about the quote?
You got the quote?
I got the quote.
Of course you do.
The quote is, the 5 most dangerous words in the business are, everyone else is doing it, by Warren Buffett.
Got to be careful. All right, let's get into
All
it.
right, let's get to it. We're not going to totally agree on everything here. I can tell you in advance right now, but
All right, so it is nice to be back, and the timer is working.
Good.
And I'm sure we'll respect it about just as much as we did in our 2022 episodes. But earnings, I think, are going to be the buzzword for 2023. Earnings, recessions, and we know right now a lot of companies are coming out to report their Q4.
100
earnings.
of them apparently are coming out this week.
Mm-hmm. It's earnings season, and this one's even more important than some of the other ones because it gives a good look at some forward guidance. So what these companies think will be happening moving forward. So it's good to get a sense of what companies in different industries are seeing, hearing, feeling, and what they think they're going to do this year.
And your general theme is?
For
Earnings
going down seems to be the forecast. So we have the chart there with some forecasted, I'm not sure why it looks like that, but quarterly revenue and earnings growth for the S&P 500, revenue growth, earnings growth over the last 2 quarters and into the new year here. So what this is showing is we're going to get earnings growth down in the first quarter, second quarter, but rebounding back up at the end of the year, which seems to be along the lines of a lot of the consensus themes for a bit of a volatile first half of the year and hopefully things rebounding back in the second half of the year.
I just don't think that they're all going down. And the reason I say that to you is I did some research.
Did some research, okay, all right.
And McDonald's posted their earnings, and they beat expectations.
Mm-hmm.
And McDonald's is not the only player, but they're pretty big.
They're a recession-proof company, I would say.
I know. You're going to give me some category. I get it. And I guess their thesis or their reason was they increased the menu prices. That always helps. And the number of people going through the doors was dramatically were up. And
Better
I guess they're advertising. I keep hearing McRib and all these other things that they're not yet
coming back out again.
Yeah. So I guess that's not an excuse, but and I guess McDonald's is not the typical place, but it was nice to see that they did beat earnings.
Well, and sometimes we talked about that these companies can beat earnings from the fourth quarter because they revise their guidance down throughout the year, as last year was kind of got worse and worse as the year progressed. So as they revise their guidance down, it's easier for them to beat their lower estimates on that. And that's all that is those beats and misses are all just estimates
relative to the previous 12 months or whatever and that would lead me right to General Motors, which did the exact same thing.
Yeah.
Their profits jumped.
Mm-hmm. Yeah.
And I guess if you're jumping from 0.0, which they had no sales, but again, they fueled by strong revenue and strong demand. We hear about we can't get a car. You're waiting months to get a car. There's no used cars. So it was nice to see them too report some significant profits.
And maybe a bit easing of the supply chains that
Well,
happened
for sure
the
that
last
helps.
6 months. They got some parts and got their chips that we've heard they all need now.
Yeah, I'm not into the
You're not into chips?
the details of all this stuff. The point is they made a profit. But my last point I want to make, and I'm not being negative to that the earnings are not going to be down. I believe they're going to be down too, is American Express. And I think the CEO, I think from the way he worded it is, we aren't seeing recessionary signals quite yet. He says that he still isn't seeing spending trends that would suggest a downturn in the cards. So again, American Express is a big player, but it's kind of neat. We're slowing down and yet we're still spending. Do you know what I mean? Like it's that in between.
People that have an American Express are going to be the last people that stop
Here we go
spending,
again.
I mean, as long as you
jab
got your
at me again.
platinum card.
Oh yeah, okay.
No,
that's fine.
So but those are some good reports, and there's a lot more coming through.
No, I know, and I just chose 3 because I have a feeling majority are going to be lower. I do agree with you there. So.
And even if they beat, I think the more important thing is what are they saying is going to happen this year. Let's not focus. I don't think the market will be too focused on the beat. It'll be more focused on what are you saying for the year. Are you saying how many times they do these studies now with big data?
Keywords.
And they do the word maps and how frequent they're said. So those will be interesting to see as we move on. And the last part of that was this chart here, which is just the S&P 500 in blue and the forward 12-month earnings per share over the last 10 years. So you can see that, the market tends to move with earnings. So that's why those 12-month guidelines of how these companies are projecting things to be are important, as they do tend to move relatively in line together, similar together. So, and now moving into our next topic, inflation. So let me update our new fancy green blocks here. Boom, got our fancy green blocks. And
I'll let you know when to start the 5 minutes, okay?
Yeah, I will get that in there.
I knew you were going to try to put it in.
So hopefully you at home can follow along a little bit more easier and know which one we're chatting about. So we are on inflation now, and clock is... I'm gonna have to edit this out. Here we go. We're back.
All right.
Timer's working.
Good.
Inflation's working. Sounds good. So second topic is inflation, and it's you can't go anywhere without hearing. What were you telling me about the commercial you saw on TV? Which neither of us watch much TV, but we both watched the Leaf game, so I'm sure we both saw it during the Leaf game.
What commercial? That pizza one again?
The pizza one.
Okay.
What was it?
Fixed rate pizza.
Fixed rate pizza.
It's almost as ridiculous as the betting apps, but I don't even know what to say to that anymore. So.
The fixed rate pizza was an interesting one. I mean, I thought it was kind of a cool marketing gimmick. That's, it was a cool marketing gimmick. It kind of looped me in.
I know inflation is a key thing, and everyone's been talking about it as we got to get it down to that 1 to 3 level, etc. I know the International Monetary Fund came out and said 84% of all the nations are going to be posting a lower headline inflation this year compared to 2022. Mm-hmm. Thanks for the news, buddy. Well, if it was up at 6 and 7 and 8, that's fine. However, they also said they still forecast an annual rate of 6.6 in 2023. That's a jab at you, because if you're thinking it's going to go really lower, and the following year 4.3. That's not for me. I didn't make those numbers up. Mm-hmm. Those were what they posted today. So I do believe inflation is coming down. I'm not.
Well, we can take a look at, we can let the people see and judge for themselves. And so.
All right, go ahead. Tell me what you see.
Sorry, continue. I just wanted to show the.
Go ahead. So what are we looking at?
So this is a chart that goes back to 2020, and the top 2 red and blue lines there that you see, the thicker lines, that is Canadian inflation and U.S. inflation.
Okay.
And the bottom 2 lines are Canadian central bank rates, and the U.S. central bank rates is in the blue there. So we can see that rates have come up since March 2022, and inflation coming down since around July 2022 there. and moving down. So again, and obviously you see the sharp rise in inflation there as well. But hopefully the good news is we don't have that runaway inflation, hyperinflation that people were afraid of. And maybe, just maybe, Jay Powell and Tiff, the boys, what they're doing with raising the rates has been working.
Well, the graph looks like we're starting to see a little bit of a slowdown. There's no question. The question is really, is it enough? Are we done? And I know you're going to eventually get to that on your next topic. But I found an interesting line looking at the word inflation. Can I read you? It's short, 3 sentences here. Inflation can be something of a wild card. It has volatility of its own and not something that any of us can just wish away. As an economic condition that ultimately affects the purchasing power of everyone's cash, it is like rain. You must prepare in advance, wear rain boots and a raincoat, and carry an umbrella in order to stay dry. So I think Mr. Powell and the TIF guy, basically the fear of what it could do has fueled this increase of rates, and it's been in the news every single day. But I strongly believe it is the right thing to do. I don't have enough brain capacity or education to know how high do you go with rates, when do you stop it, and that's the $1 million question that I think all of us are trying to figure out.
Yeah, and I think you could pause, and I think the rebound inflation and it coming back up is the worry. So is there another storm cloud of inflation coming through, to play off of your example there?
They could stall, but just stalling doesn't mean they will not go back and raise. If all of a sudden there's a period of time where inflation has not shown an improvement, so you're right, you could stall. But there is danger to that as well. So,
and I think the main thing is that the higher interest rates are going to start affecting
absolutely
the average Canadian, and so that's eventually could lead to some problems. And there was a lot of pandemic statement. We're going to talk about that again, but the hope, like I said, in Jay Powell we trust from a previous episode. Let's not push it too far, too fast, but let's make sure...
I'm not trying to laugh.
Let's make sure the wolves are gone and not hiding in the bush anymore, and inflation isn't going to bounce back.
But it's not over. Inflation's not over. What I'm trying to say, it's not over.
One of the reasons we showed this chart here was because historically, and you can see it at the start of the chart there in 2020 on the left-hand side, historically, these rates, inflation and bank rates, central bank rates, tend to move together. So we've seen them come closer with the bank raising and inflation coming down. But eventually, we want those to see those get closer together and start to track again like they normally do. So whether that is, as you were saying, raising rates further, I'm more in the camp of inflation coming down and meeting up with the central bank rates, and so that leads into our next topic, which let's see if we can do this one a little bit more smooth. And let's go like that. Where's my green? Oh, we almost got it. Boom. Yield curve inversion. Don't sound so excited about it.
I've heard that term many times.
Don't sound so excited about it, Jerry. Yield curve inversion. So it's a bit of a busy chart here, but what you're looking at here is a chart that goes back all the way to, I believe this goes back to 1990, 1980, late 1980s, 1990. So what you're looking at here is every time the red area is above the blue area, we can see that there was a recession, and recession is the gray line there. So the red area is the 3-month Treasury yield in the States, and the blue is the 10-year Treasury rate in the States as well. So this is called the yield curve inversion, and you may hear this on news stations, TV, on the internet. Usually they're talking about when a 2-year rate inverts with a 10-year rate, which that means that you get paid more, a higher yield on a 2-year basis than you do on a 10-year. Which historically is not normally the way that things are. You should be paid for having your money there for longer. So for
right.
the longer duration. So with the 2 and the 10 year, the actual percentage of the time that we get a recession after that is not very, it's not a very good sign that we are going to get into the recession. When the 3 month and the 10 year do, this thing has a near 100% hit rate. So not great news if you're in the we're avoiding a recession soft landing camp. This indicator, which is just one indicator.
Well, all the data I've read says that the inverted treasury yield is one of the most reliable leading indicators of a recession. They keep saying that over and over and over again.
And you can even see in late 2019, it inverted, which was before COVID. And then, of course, COVID, we had the recession there. You can see that gray line. So we are right now, we've been inverted since November, October 28th. This particular indicator, 3 month to the 10 year, has been inverted. So, again, not a good sign for the recession camp.
So it just doesn't happen very often, I guess. The bottom line is when long-term interest rates drop below short-term interest rates, investors just moving money around from short-term bonds into long-term, and all these things tend to mean a slowdown is coming.
Yep.
So, the average person doesn't pay attention to short-term, long-term, all these fancy
I think
words,
it's
right?
and I think why we bring it up is because of the reliability of the signal. So when it inverts, we're normally going to get that recession. And so what do you see during a recession? Well, you see inflation come down a lot, and usually rates get cut. So obviously you see economic slowdown and a downturn because it is a recession. So it's about being prepared, as you said, because the spending typically slows down. But potentially better for a 1 year outlook, for looking out 1 year from now. If we can get through that recession quicker, then it's more
the
positive.
word recession's been in the news every single day, right? So, and everybody has their theories. Every economist gives us the reason why there will be one, there won't be one, soft landing, hard landing. But if you try to be in a neutral camp and try to understand this yield curve, which is now, it's not manufactured, it is what it is, that tends to, as you would say earlier, the 3 month one is almost 100% guaranteed. The 2 year one has a little bit of give to it.
And it's such a catch-22 of a situation, because of course we don't want to see a recession.
No.
But the recession means inflation getting back into check, rates coming back down, which would be two positive things. So it's a bit of a catch-22 in the fact, who's cheering for a recession to happen?
Short-term
Nobody.
pain, long-term gain.
But it's you go, okay, your interest rates coming down. Well, that would be nice. It creates more business opportunities and helps
with
the
debt.
markets, and helps with the
control.
consumer debts and that stuff, and even government debt that's obviously been going up as well. So this was an interesting signal that we thought we should bring up, as just the hit rate on it and the success rate is high. So what does that mean? Hopefully a pause in raising rates, and eventually a cut in raising rates, or a cutting rates, sorry.
Okay. I wouldn't be so aggressive in
said
predicting
eventually.
cut of rates.
I said eventually.
Okay.
Eventually.
Eventually could be a long time. But anyway, okay.
Okay, on to the next topic here. Okay, so we got that. And if I just go... Okay, so we're on to the consumer here. And hopefully that 5-minute clock is reset. Perfect. Great, so we wanted to talk about where the consumer's at, as obviously that's our clients and us, and where the average Canadian consumer is.
And consumer spending is huge.
And consumer spending has
no
a big,
joke.
yeah.
It's a massive 70% of U.S. stuff is made and sold to the consumer. So,
and when we're talking about inflation coming down, you talk about demand for goods, and how if the demand remains high, it's tough to see inflation coming down because people are still willing to spend. So how is that all playing out? So here's U.S. and when you look at Canada, it is around the same. So the U.S. again, we've talked about this before, has a bit better data, or maybe I just haven't found the good Canadian one yet. But the U.S. personal savings rate is at the lowest it's been since July 2005. So this is the U.S. personal savings rate as a percentage of disposable personal income. And it's hovering around 2% right now. And this chart goes all the way back to 1929. So on the negative side, excuse me, of this chart, the savings rate is at its lowest it's been in a long time. The positive side of this chart is it just was at 35% through the pandemic. So the pandemic savings, you weren't taking your car out, you weren't paying for gas, you weren't going out as much. So the savings rate, we saw that really spike to its highest level. So that's the good side of it. The negative side of it is, of course, that we have no savings rate as of right now. So we've also seen overall savings of Canadians and people in the U.S. drop as well. So that has been coming down quite substantially too, where people are using their pandemic savings. So that's all being spent up, which is not a good sign.
Yeah, like consumer spending, it falls into all kinds of different areas of, what's your disposable income? How much income per capita does the person have to spend? Then there's people that have lots of money and they're still saving a chunk of it, whereas the vast majority, like your savings rate just said, have depleted it. The one that I always come up with is, household debt. Just what do you need to stay afloat? And factor in mortgages and rents and food costs. And there's more money going out the door, hence there's less to save, and that's part of the equation here.
Well, and higher rates, higher costs to
everything
on your line of credit
more.
And your mortgage rates, that kind of stuff. Higher savings rate if you're in that category, but we're talking about consumers here. So those higher rates eat into what you can save. But because we had those pandemic savings built up, it could delay the effect of the consumer really feeling those higher interest rates because they were able to
they're using that money
by using that savings. But eventually, as we're seeing, these savings are running out. And when the savings run out, that's when you're more fearful that the spending is going to be coming down.
There's also consumer expectations, right? If they feel confident, they're just going to spend. So if they get to the point where they just lack the confidence.
Well, and that's usually when you start hearing recession all the time, then that's when people start going, okay, I got to batten down the hatches.
My viewpoint on that. I've been talking to you about it, and I keep joking about. I don't see a recession here yet. Like there seems to be still money being spent.
U.S. GDP was 3%, and they were up just over 2% for all of 2022. So despite that, they're still growing, albeit at a smaller rate, but they're still growing, still growth there. Unemployment, we're going to talk about that in the next category, but at historical lows as well. But I think for the consumer, the concern is once those pandemic savings are depleted,
what happens?
They're going to stop that spending and have to really cut back, change their lives. So that's why
which is leading us back to the recession statement again.
Which is leading us to the recession, right? And
getting us back to...
And leading us to the Fed raising rates, central banks raising rates. How many more can they do here? Because
3.
People are going to start feeling it. Okay.
Am I allowed to say 3?
You can say whatever you want as long as you disclose that.
Well, I don't know.
That is not a... Yes, exactly. Yep.
I read this morning, one of the bank guys,
okay.
I think maybe it was Bank of America, that until those numbers come in, some of the market is in this United States, by the way.
Yeah.
Because they have, obviously, like you said, way more data than we do. They're saying potentially 3 small, which leads us back into third quarter, end of the second quarter, third quarter, by the time this is all, the dust settles, right?
Yeah, yep. And back to the chart we had off the start where you want inflation and interest rates to kind of meet up again.
Get close.
Maybe they need to bring it back up to that level to kick that inflation down to that last thing and make sure they have it in check before they start taking it easy on that. So we're on to jobs, and we wanted to talk about unemployment and wages. Unemployment has been quite resilient in...
and I know you have a fancy theory.
I'm going to surprise you on this. I'm going to surprise you on this.
But I'm not making fun of your fancy theory.
I'm going to surprise you on it.
Okay, go ahead.
Well, so with the unemployment and wages. So if we were to start with wages, the wage aspect, we've seen, we had an interesting chart about, where was it here? There it is. So what you're looking at here is the median wage going back to 1985 and the change in that versus the average growth in wages advertised in job postings. So an interesting stat that I hadn't seen before where they take the average growth in wages advertised in job postings. So you got a job that's posted for 100,000 in 2020. In 2021, that job was posted saying that, applicants, the successful applicant would get 106,000. So you could see that wage growth happening in the job postings, what they were posting. And now that number's come down to 104,000 if we were using that example there. So we've seen that come down, which it has tracked with the actual median wages. And so a good sign for wages, this is from Indeed, one of the big online employee search, career search places, hiring sites. So when you look at this, you go, okay, maybe wages are going to come down. So from the consumer standpoint, you don't want wages to come down, but from an inflation standpoint, you would want wages to come down because if they stay high, that means the price of the goods stays high as well. So
inflation will not come down. Wages have to at least flatline. I don't know.
You're right. Yeah.
Like I remember it was a few months ago in BC. I can't remember what union it was, wanting a 7 or 8% increase to keep up. Well, if you give the 7% increase, because inflation at the time was running 8.1 or whatever, and then we get it under control, is that union giving that money back?
You can't go to your employees and say, well, we're going to cut your wages now because inflation pressures aren't as high. And so that's where they say wages are more sticky because once you make that increase, it tends to stick.
And we've been hearing how it's hard to find employees, it's hard to find good people. How do you find them? Pay them more money because things are going okay, but are the things going to go okay 6 months from now, a year from now?
Exactly.
So it's kind of an uncomfortable circle. You just keep going around and around. And with all this inflation talk, they don't really talk about wage inflation. They just briefly mention it, but it could become a major topic here if they get the rest of inflation in line. If they eventually, I'm giving you a massive raise because food bills and everything was going sky high. Therefore, we're giving it to you, but now food is back in line. So what are you doing with that extra money that you didn't need anymore to offset the food cost?
And with unemployment so low, it's tough, as we've talked with business owners that are clients and people that we know. It's hard to find good people.
Yeah. And
so you got to pay good people to keep them, which helps the wages keep going up, right? The unemployment side of it, I wanted to talk about. So the unemployment rate is calculated by the number of unemployed people divided by people in the labor force, which includes employed and unemployed people. So it includes the both of them. So part of that number...
And unemployed people are people looking for work.
Unemployed people are people that are out of work and actively looking for work. So the labor force participation rate is a good gauge of of where they come up with that unemployed number, because the labor force participation rate is the unemployed plus employed divided by the population, basically. So we've seen that come down substantially. So when this number comes down, the labor force participation rate, which you can see here, from pre-pandemic highs of 64, just under 63, 64%, down to 62, not a huge change, but when you think of the hundreds of millions of people in the US, it does have an effect on the unemployment rate and can drive it down. So we all have heard.
So you don't believe it? You don't believe the unemployment rate?
The unemployment rate is, it makes you question it. It makes you question what you're seeing there, because maybe it's a bit artificially lower because you have a lot of people leaving the unemployed line because they're retiring, they're going back to school, doing things like that. And we've seen talked to a lot of people that are in that same boat of retiring, coming back out of the pandemic, not interested, going back.
It does skew the number. I don't know to what degree it does, but I'm agreeing with you. It does. And seeing Canada 4.9, 5.1, which is a historically extremely low number. Recessions, at least the way I remember it way back in university, are linked to high unemployment. Like eventually,
yes,
people lose their jobs, right?
Yeah.
They lose their jobs.
Well, what's the adage? Recession is when you lose your job. Depressions, or recession's when your neighbor loses your job, and a depression's when you lose your job.
The other way, I think.
No,
the other way?
Depression's worse than a recession.
All right.
You'd rather your neighbor. No offense to your neighbor, but
I want to do that to my neighbor.
If it comes down to it, But the second part of this, which I haven't shown you yet, so surprise on this one here, is the U.S. labor force participation rate, now age 25 to 54, is at the average level that it's always been at. So what this would mean here is it's older people retiring, 55 and over retiring, and not so that downturn in the labor force participation rate, which we see here, is not as much the younger people not entering the workforce, because we can see that those numbers are, in line with where they've been historically. This is going back to, we're in line with where we were all the way back to 2008 here. So I think that when I saw this element in my research from one of the podcasts that I follow, Animal Spirits, this tells me that, we have a lot of people retiring. And who are those people? Well, they're baby boomers. And we always knew that there was going to be a kind of that mass exodus of baby boomers. And the pandemic might have just kickstarted them.
Accelerated it.
Yeah.
I had enough. Cash me out. Even before a pandemic, that group of people was going to dictate anyway. And if the number was 60 years old or 58 or 62, we see from our clients a very large amount of people, or a large quantity of people that 55 to 65 have said they had enough. And they do take consulting jobs, and I don't even know if they even show up on this unemployment stat thing, okay? Because I'm not sure how
they show up on there as well. But
so
I still think there is a lot of people that are going out traveling from not in COVID and all that. So I think it does affect the numbers, but as you know, Jerry, you can't just take a chart for what it looks like. You got to dig a little bit deeper sometimes and get down to it. So hopefully we wanted to do a quick update on each of those things, as they're all very important in whether we're going to be in a recession, what's going to happen to inflation, the earnings and the yield curve and the consumer and jobs are all big parts of that.
Everything's linking to what's going to happen to interest rates, which is linked to inflation, and the key word is recession. So none of us really know, but I think presenting the charts today, like you said earlier, we're not really thrilled to say it looks like a recession, because we really don't know. But everything is pointing towards this. And all I can say, based on my age, it's not really a disaster. We just need to do it do what we have to do to prepare for it.
Be prepared and have a plan.
And go forward.
Have a plan, right?
It's happened before. You know, like you make fun of me back in the 80s when interest rates were extremely high and stuff like that. It's pretty bad now too.
Me? Make fun of you?
Oh,
That doesn't
on
sound
a
like me
daily
at all, Jerry.
basis,
I mean,
but
I
we'll
don't-
leave that
doesn't
for
sound
another
like me.
time. So, I think what they've done by increasing rates has worked. I think the lagging effect is coming, and I think everyone, as long as they're aware of it, will be fine.
And with all these big topics here, we figured we'd put the Canadian flags in the background like we were doing an official press conference here. We got all the Canadian flags in the background behind us there. But hope you enjoyed the episode and stay tuned for more.
Sound like a CEO of Philotimo Wealth, like
hey.
Chief Financial Officer, Chief
Are you the-
Executive.
are you
I
the
don't know what I
are you
am.
the
I have no
CEO
idea.
or who are
But
you?
there's
Yeah.
Canadian flags on a podium.
There you go. I figured you'd go for president, not CEO. But
They just sound impressive. Titles.
thank you for watching,
Thanks,
and look
guys.
forward to a lot of cool stuff from us.
CJ Stevens and Jerry Kalitzis work for Investia Financial Services, Inc. All opinions expressed by CJ and Jerry are solely their own and do not reflect the opinions of Investia Financial Services, Inc. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Investia Financial Services, Inc. may maintain positions in the investments discussed on this podcast. Mutual funds and/or exchange-traded funds are offered through Investia Financial Services, Inc. Insurance products and services are offered through PPI Management, Inc. and through multiple insurance companies. PPI Management, Inc. is an independent and separate company from Investia Financial Services, Inc.